Internal Revenue Service IRS Tax News. Here's who qualifies a taxpayer for the Child and Dependent Care Credit. IRS Tax Tip 2020-68, June 10, 2020. Childcare or adult dependent care can be a major expense. Fortunately, the Child and Dependent Care Credit can provide some relief. Taxpayers who pay for daycare expenses may be eligible to claim up to 35% of what they spend. Limits apply. For the purposes of this credit, the IRS defines a qualifying person as. We got a qualifying person for the purposes of this credit. So these are going to be the people that may possibly be a qualifying person in order to take the credit. Back to the text, a taxpayer's dependent who is under age 13 when the care is provided. This is probably the most common scenario. So a taxpayer's dependent, so we have the dependent and the age limitation under 13 when the care is provided. The next item, a taxpayer's spouse who is physically or mentally unable to care for themselves and lived with the taxpayer for more than half the year. So the spouse, if they are physically or mentally unable to care for themselves and there's that living condition. Then we have someone who's physically or mentally unable to take care of themselves and lived with the taxpayer for 6 months and either. So now we've got someone who's not the spouse, not necessarily the child, but someone who's physically or mentally unable to take care of themselves and live with the taxpayer for 6 months, and either one, the qualifying person was taxpayer's dependent. So in this situation, that would typically be the case, right? So if you got someone who's physically or mentally unable to take care of themselves and they live with the taxpayer, then you would expect possibly they would be on the tax return as a dependent and therefore could fall under someone that would qualify possibly for the credit under that situation, and that would be where you stop. However, if they weren't a dependent for whatever reason, then you're going to continue on to the next point and see if they would still possibly qualify as we go forward. So then too, they would have been the taxpayer's dependent except for one of the following. So now we're thinking about those types of things where they were not a dependent, and for one of these types of reasons, even though that would kick them out of like kind of the dependent threshold, so they wouldn't be a dependent, but still may qualify for this particular credit. So the qualifying person received gross income of $4,200 or more. So if they were not a dependent because of the gross income limitation of $4,200 or more, then they may not be a dependent and still may qualify for this credit. The qualifying person filed a joint return. So if they didn't meet the joint return test, so they weren't a dependent, but they still may qualify. The taxpayer or spouse, if filing jointly, could be claimed as a dependent on someone else's return. So those would be the three conditions where they would kind of take them out of the dependent status, not be in the dependent status, but still possibly if the other condition is met, number one met, then may still qualify for the credit as a person that could qualify the taxpayer for the credit. So taxpayers can use the Interactive Tax Assistant. There's a link to that tool here. There'll be a link to this in the description on irs.gov to determine if they can claim this credit. More information, there are links to these items as well, which include the Child and Dependent Care Credit and Publication 503, Child and Dependent Care Expenses.